Hello everybody, Luke Gromen, founder and president of FFTT, Forest for the Trees. Hope you're doing well on a Sunday night here. Wanted to check in with you really quickly on the two things that grabbed my attention recently. In keeping with the format, I'm going to run through two things quickly. First is I've had a number of questions or requests for thoughts on the Steve Bannon interview with Kyle Bass on Real Vision. I thought it was a tremendous interview. Looked at a number of different things. A couple things. First off, it identifies a number of important issues, economically speaking, in terms of trade balances, etc. I do question if it is possible that it might be a little bit too little too late, or we might be trying to close the barn doors after the horses have already left. That remains to be seen. I would also highlight, when you pair it together with the interview last week where they talked about, or talked with Miles Kwok, the Chinese billionaire, Kyle Bass brings up a point that he thinks as much as 45% of $40 trillion in Chinese loans might be bad, for lack of a better word. I would obviously defer to him on the depth of analysis that he does. What I would say is that Lehman Brothers was an $800 billion balance sheet, and when it had problems, it brought the global economy to the brink of collapse, global financial system, and with it, economy to the brink of collapse. 45% of 40 trillion is, call it 18 trillion between friends. If 800 billion was enough to bring the system to the brink, I gotta believe 18 trillion is, that the second and third derivative impacts would likely be, to say the least, enormous. And so I question, what would happen. I question if markets would even be allowed to stay open if something happened to China in a relatively rapid fashion. Lastly, ideas, that Bannon floated in terms of a showdown with China, I thought were particularly controversial. My question would be, funded by whom and fought by whom? Funded by whom? Asking China to fund the United States and sell the United States the goods to fight China is probably not a sustainable strategy, as noted by Chairman of the Joint Chiefs of Staff, Admiral Michael Mullen, 7 years ago. And fought by whom? When you take a look at who you would need to step up, you'd be looking at red states are overrepresented. Middle America, flyover country, is overrepresented in terms of the folks that you'd be expecting to be involved in a showdown there. And I think they're a little weary and maybe even a little cynical about some of the military adventures we've been on over the last 20 years. So I thought it was a really important piece to watch. If you have access to it, continue to think that's a great, Real Vision is just a tremendous news service. So those were the thoughts there per some requests. Secondly, you've got another big issuance, Treasury issuance week this week for the U.S. Treasury market, particularly in the first half of the week. FX hedged, or foreign exchange hedged, Treasury yields remain nominally negative for foreign buyers. Continue to think this might be one of the biggest stories in markets that very few are talking about, at least in sort of on the punditry side. I will say lots of investors are talking about it. It has very important implications. The bottom line this week, though, is I would not be surprised to see another bumpy week in terms of rising yields and potentially choppy stock moves or down stock moves. Because again, as long as FX hedged yields remain negative, foreign buyers may be a bit more reticent to participate. So we'll leave it at that on those 2 points. In terms of questions I had from people on my Twitter feed before this presentation, how and why can the U.S. and China use gold to solve problems? It's kind of two sides of the same coin. China needs to get away from the dollar. China needs to have credibility to settle, price more of their commodity import bill, in their own currency, a currency they can print, and using gold or offering gold settlement at a floating yuan rate gives them credibility to be able to do so. And so it is. I think they understand it's an Achilles heel to the dollar-centric system. U.S. Actually, the U.S. could use it if, and I don't think this has a chance, a snowball's chance of hell of happening, but if Treasury or the IMF or the Fed bid for gold at a really high number, it would effectively reliquify, devalue sovereign debts, dollar-denominated sovereign debts. Globally, it would be very positive for economic growth across the world, including the U.S. It would, however, be negative for the relative standing of the U.S. dollar's reserve status, and that's why I think it has a snowball's chance of hell of happening. So that's kind of how they would use it. I'm going to open it up for questions here, and I would say to you, or highlight to you, excuse me, again, we've got a paid subscription, or excuse me, a paid webinar event coming up next Tuesday, November 13th. Check out our website, FFTT-LLC.com, for more details. We would be, we're going to have, it'll be 2 hours, limited number of seats. We're going to have a full slide deck we'll distribute to those who have signed up for it ahead of time. We'll run through that slide deck, and then we will open it up for Q&A for the balance of the time, and I think it's going to be real productive. It'll be a year-end outlook, or recap and outlook, more importantly, in terms of the things we're seeing. So hopefully you'll be able to join us for that. I'm going to open up for questions real quick. So let me see. Can you elaborate on how does the owner's equivalent rent in the CPI have an impact on Treasury yields and the dollar? Hi, Brad. Thanks for joining us. Great question. Owner's equivalent rent is one of the biggest components of core CPI, and to the extent that you see rents peak and begin falling, conceivably it could be a dovish influence on core CPI, and as a result, all else equal, would be bullish for Treasury bonds, bearish for Treasury yields. In other words, would be supportive of data that would say the Fed wouldn't have to tighten more, and it would be, all else equal, drive lower yields. I think there's other markets, all else is not equal, but all else equal, that would be the case there in CPI. What do I think about a possible link between the yuan and gold? I think what China began doing 4 years ago in the third quarter of 14, when they opened the Shanghai Gold Exchange International Board, was to basically reopen the Bretton Woods gold window at a floating price through yuan. And to us, it is less. I do not think they are going to back the yuan with gold. I do think they are using gold as a means to an end, and the end to them is the ability to become, or the second nation in the world able to print their domestic currency for oil. If China can print yuan for oil, a lot of the yuan bear case, and let me back up. When I say print yuan for oil, I mean oil and other commodities, but oil is obviously the biggest. But if China can print yuan for oil and other commodities, a lot of the bear case on the yuan having a balance of payments, the Chinese having a balance of payments crisis, a la Southeast Asia, a la Russia, a la Argentina, a la Latin America, that would, these EM crises we've seen over the past 30, 40 years. If China can print yuan for oil imports, that whole bear case gets downgraded in a big way. And so that is how we think they are using gold. It's a means to an end. Nobody trusts yuan, but everybody trusts gold. And so I think what they're trying to do is get more and more oil exporters to accept yuan, with the understanding that that offshore yuan can be recycled into physical gold if they would like, in Hong Kong, in Shanghai, in Dubai. And of course, it wouldn't all be yuan for gold. It would be yuan for Chinese goods, and some surpluses to that. Any surpluses to that would have the option to be settled in gold. Let's see, any other questions we have tonight so far? There's some detail there in the feed about registering for our 2018 wrap-up webinar I mentioned earlier. And let me see, it doesn't look like we have any other questions for the night. If you have any, let me know. I'm going to hang on for about another 30 seconds here or so. All right, well, so kind of a quick one here tonight, guys. Thank you guys all very much for jumping on. I appreciate it. And again, FFTT-LLC for more details on that webinar. Otherwise, we look forward to chatting with you again soon next Sunday night. Take care, guys.